Hi guys, it's Stock Harry, and after the stock market rose for 4 months in a row, it fell again in February. Now you might be wondering what the stock market is going to do in March. I'm going to show you exactly what people are predicting for March and the rest of the year, so let's get into it. The key question that you need to know the answer to is, should you take profits now or wait in what could be a make or break March for the stock market for 2023? The bottom line is that the January effect, that is a bounce after the December tax loss selling, was strong, but it didn't see February follow through with more buying, which means March could make or break investor sentiment. And the fear and greed index has been dropping for the past 3 weeks in a row. It is now almost back to neutral. Keep in mind that when market participants are greedy, this market sentiment indicates that stocks will continue to go up. And when market participants are fearful, this market sentiment indicates that stocks will continue to go down. And right now, the market sentiment, the fear and greed index, is very close to neutral, meaning we don't know which way stocks are going to go, and it's all going to come down to whatever happens in March. Now, historically, the market's movements in March have typically been more encouraging than they are in February, rising in price 64% of the time since 1945, and recording not only the 5th highest average gain, but also the 5th lowest volatility. Now, it can be easy to look at that historical data and say, okay, we have a 64% chance of rising. That means stocks are going up. But we have to understand that 64% chance of rising also means a 36% chance of going down. And further, if one thing this bear market has shown us over and over again, ever since October onward, is that the historicals just don't matter. This market has destroyed numerous historical records, even some records that have been around 80, 100 years, never broken. This bear market broke those records. So I would not take a lot of insight into the fact that the market normally rises in March, because this bear market just has been anything other than normal. So just take a little bit of caution to that. It may be encouraging, but don't get too encouraged. Definitely remain cautious. DataTrek's bias is also towards caution, but we will freely admit that one can make a good argument either way. In the end, we are still concerned that current U.S. equity valuations leave little room for error or uncertainty. Because the PE ratios and PS ratios in the market right now, that is the current valuation of stocks, is at near an all-time high. And in the case of PS ratios, it's actually at an all-time high. This indicates that the stock market is still fundamentally overvalued, even after last year's drop. And that means that stocks, especially when it comes to earnings, they're going to have to execute perfectly if we are going to see the stock market continue to rise. If companies continue to report disappointing earnings, and if company earnings continue to decline, as they have for the past 3 quarters in a row now, that could be a very strong indicator that this attempt at a bull run is going to fail, and March is going to actually be a down month, which could in turn that market sentiment bearish. And if market sentiment turns bearish, we could continue to go down, possibly even down to new 52-week lows. Now, I do want to take a real quick look at the technicals, because we are at some pretty important technical points right now. The 10-year treasury yield reached 4% for the first time since November. It closed at 3.996%. 4% is typically considered the level at which the stock market would crash. And the reason for that is once the 10-year treasury yield gets above 4%, a lot of money starts getting pulled out of the stock market and pushed into the bond market. The reason is people generally don't want to keep their money in the stock market where it's very risky. They would rather put it into the bond market where their investments are going to be fairly safe. And in retirement, people are always trying to pull out 4% per year. That's the general agreed upon rule amongst financial advisors. So if you can get 4% or more per year in the bond market as a very, very safe investment for retirees and pension funds and many other large investors, that 4% yield is extremely attractive. And a ton of money gets pulled out of the stock market and put into the bond market once those 10-year treasury yields get above 4%. And we actually hit it today. We didn't quite close there. So if we do actually get above 4% and stay above 4% on that 10-year treasury yield, this could cause a significant decline in the stock market as tons of money gets pulled out of the stock market and put into the bond market. Don't forget that the bond market is significantly larger than the stock market. So a small move in the bond market can create a large move in the stock market. And it's not just the 10-year treasury that is at a critical level here. The S&P 500 also closed just above the critical 200-day moving average. The S&P 500 closed just 0.25% above the 200-day moving average on Wednesday. Keep in mind that if the S&P 500 were to fall below the 200-day moving average, that's the white line on this chart, that would trigger a massive sell-off from algo trading computers. The algo trading computers have been programmed to sell once the S&P 500 drops below the 200-day moving average, and that could trigger an immediate and massive sell-off in the stock market and would more than likely send the S&P 500 down over 5%, down to the 3,800 level in a very short amount of time. So we have these critical technical levels that the market has to stay above in order not to crash. And this really is the big question in March. Will the market go up or will the market go down? That could be determined over the next week or two as we see whether or not the S&P 500 can stay above the 200-day moving average or if it's going to fall below it, and whether the 10-year treasury yield can stay below 4% or if it's going to rise above it. If either of those things happen, we could see an absolute market crash. However, it is equally possible that we could bounce off of these levels and we could currently be sitting right at the lows for 2023. We're just not going to know which way this market is going to move for about another week. We're just going to have to wait and see. Now, earlier I said that the market would have to perform pretty much perfectly this year when it came to earnings in order to maintain those extremely lofty valuations that we currently have in the stock market. So let's take a look at some of the earnings that came out on Wednesday and see how companies did. Salesforce shares jumped after the software company issued a full year forecast that beat estimates. Salesforce beat expectations across the board. They beat on earnings, they beat on revenue, and they beat on their full year guidance. Part of the reason Salesforce beat estimates is because they did layoffs during the quarter in order to become more profitable. Earnings per share came in at $1.68 versus $1.36 expected. Revenue came in at $8.38 billion versus $7.99 billion expected. It should be noted that those earnings were adjusted and was not the true earnings for the company. Salesforce revenue grew 14%, but the company still reported a loss of $98 million on the quarter. Salesforce shares were up 14% at the time of the screenshot. They were up almost 15% at the time of the recording of this video. Keep in mind that Salesforce makes up 3.3% of the Dow Jones Industrial Average, and this is one of the reasons why we see the Dow Jones up 0.4% after hours. It's mainly due to the fact that Salesforce just skyrocketed on better than expected earnings. Snowflake stock unfortunately fell after earnings as their forecast underwhelmed. Snowflake stock was down about 6% after hours as of the recording of this video. Plug also reported earnings after the bell, and their stock was down slightly as well. So that's what's going on with the earnings. We've seen very mixed results from earnings this year. And even though a lot of companies have beat earnings expectations, the actual earnings, the year-over-year earnings, we've seen significant declines in earnings. So when I say that companies have beat earnings expectations, that does not mean that they have reported great earnings. That just means that their earnings weren't quite as bad as they were expected to be. So perhaps expectations were horrible, and instead of the earnings being horrible, they only came in terrible. I'm sure those words are interchangeable, but you get the idea. Maybe instead of a company having a 50% year-over-year decline as expected, they only had a 40% year-over-year decline. Terrible earnings, but since that's better than expected, we see the stock price rise for a couple of days. That's kind of where we're at, kind of what we've seen. Now, in order for stocks to continue to go up in the long run, though, say over the next 3 to 6 months, we're going to have to see Q2 earnings come in better than expected as well. And that's kind of the big question mark that we don't know yet. Again, it's one of those things where we just don't know which way the market's going to go from here. It could literally go either way. So if you're a bull, you can make a very good case for this being the bottom of the stock market and the stock market going up from here in 2023. If you're a bear, you can make an equally good case for the stock market dropping and hitting new 52-week lows this year. Both scenarios are equally plausible. We have no idea which way the stock market is going to go from here. Fundamentally, the stock market would point to more downturn, which is why most large investors remain very, very cautious. But technically, we could just as easily get a bounce here, and the stock market could be a little bit more forward-looking than people are expecting, and we could see the stock market rally. Let me know in the comments below which way you think the stock market is going to go. If you got a lot out of this video, then be a good friend and share this video with your friends and family so that they will know what's going to happen in the market this year as well. And make sure you hit the like button and subscribe. And if you're on YouTube, click the bell icon and click all so that you can get notified when I release my next video. And it's very important that if you missed the video I uploaded yesterday where I talk about some new recession indicators, you need to go watch yesterday's video so that you know what's going on with the fundamentals of the market, which in turn will give you a better idea of where the stock market might go this year.